A very good morning to all my viewers. In this session, I'll be taking you all through how to prepare pro forma financial statements. Before we begin, please subscribe to this channel so that you will be notified with the upcoming videos which are related to this and all videos connected to the financial management, accounting, and basically finance domain. To begin with, let us understand what is pro forma financial statement. So here basically we are trying to learn how to prepare a pro forma financial statement for any firm. And before we learn how to prepare, it's good for us to know what it is. What are pro forma financial statements? So this word pro forma is a Latin word. What it means is, in Latin, pro forma means for the sake of form. So, pro forma financial statements are a way of forecasting a company's financial results for a future period. So, basically, your pro forma financial statements are nothing but the projected financial statements of a firm for the future years, for the future period. So, you're forecasting the company's financial results. With the existing results, based on the existing results, you are forecasting the company's future financial results, and you create them using the historical financial statements and the projected cash flow to determine how a company operates in different scenarios. So, a pro forma financial statement leverages the hypothetical data. Hypothetical data is nothing but the assumed, presumed data or the assumptions about the future values to project the performance over a period that hasn't occurred. Basically, you are trying to forecast the future performance of the company with the help of this pro forma financial statements. And future is uncertain. We don't know. We will not know at this point of time what is going to happen. But using the past data, using our observations and our judgment, we are going to prepare the future financial statements, which is nothing but the projected or the pro forma financial statements for the firm. So, pro forma financial statements are defined as the financial statements forecasted for future periods. So, financial statements forecasted for future periods are called as pro forma financial statements. These pro forma financial statements may also be referred to as financial forecast or financial projection. Since the term pro forma refers to the projections or the forecast, it can apply to a variety of financial statements, including income statements, balance sheets, cash flow statements. So you can prepare pro forma balance sheet, pro forma income statement, and pro forma cash flow statement. See, traditionally, financial statement analysis is used to better understand a company's performance over a specific period. See, you will take the 5 years performance of the company, and with that data, you will be able to understand the company's performance over a specified period in a better way. While your financial statement analysis provides insight into company's historical health. See, when you're doing financial analysis, you are using the historical data. So it will tell how it has been, the health of the firm over the period, that is the past historical health. But creating pro forma financial statement focuses on its future. See, so far, whatever you have learned how to analyze, how to prepare the financial statements using the current data or the past data. But now, with this, you will be learning how to prepare the financial statements for the company for the future period, which is still not occurred. So for this reason, these reports can be leveraged in several ways. So we have understood what are pro forma financial statements. How are these statements used is, usually they are used in several ways. This pro forma financial statements or reports can be leveraged in several ways, including analyzing the risk, projecting investments, and showing expected results before the end of the reporting period. So today you are showing the expected results at the end of a particular period, after 6 months or after a year. So one of the most important uses of pro forma reports is related to decision making and strategic planning efforts. So with that future forecast, you can actually make decision and also strategically plan how whatever your projected or estimated can be achieved in future. For example, you might create a pro forma financial statements to reflect the outcomes of three investment scenarios for your business. Doing so can allow you to conduct a side-by-side comparison of possible outcomes to determine which is favorable and guide your planning process, guide you when you are planning for making the investment decision. So, Proforma financial statement basically helps in strategic planning and also decision making. So, this is where it is used. Okay, now let's. This is a basic theory of a Proforma financial statement, and it can be prepared with lot of logic, reasoning, and all that. We will look into it. So here, what we do is to create. How do we create Proforma financial statement? Hope you all can see this Excel. So here I have data of a firm, the financial data of a firm for 1 year. With the help of 1 year, we can prepare. And before we start with how we are going to prepare the projected financial statements or pro forma financial statement, I'll tell you the method we use here. So here, with this hypothetical example, we have taken 1 year income statement and balance sheet. With this data, we are going to prepare the pro forma balance sheet and pro forma income statement for 5 years. We are actually can prepare for n number of years, but here I have taken for 5 years, which is ideally, ideally every firm or they are going to prepare for 5 years. And here there are a lot of methods which can be used for preparing, but here we are going to use the percentage of sales method for preparing the projected income statement and balance sheet. And this percentage of sales method is a very popular method. It is the most oftenly used method by any person who prepares the projected or pro forma financial statements. So we are using that method. And here, I hope you all can see this input data. So this input data is our assumption. This is our assumption. Okay, and how we get this input data is that there are this input data can be predicted or it can be identified using two techniques. One is quantitative technique of forecasting. The other one is qualitative technique of forecasting. As a name itself says, quantitative refers to numbers. So if you're using quantitative method or the technique of forecasting, then you'll be using the past evidence. You're going to pick the past numerical data of the firm, and based on that, you're going to have this input data. Okay, or you can also use simple moving average method, and there are a lot of other methods. And if you're using qualitative method is basically very subjective, and how you arrive at qualitative technique of predicting these values is through your observation, through your opinions. Maybe you feel, or through your educated guesses. Maybe you would have seen or observed this firm for quite number of years. Then you have some guesses which has some backup. So that can be qualitative technique of forecasting or identifying, predicting these values. Or you can also do the market research. You can take the public opinion by doing a market survey. So here for while preparing the pro forma financial statement, I'll be using the educated guesses or the opinions. So assumptions can be either got through doing a survey, or it can be also through your opinions, through your observation, you can assume. So here I have used my opinion or educated guesses. So with all the observation, I have taken sales growth to be 33%. Through the observation, I feel that this firm's sales grow every year by 33%. So that's how I've taken. Tax rate, looking at the system or the environment, I feel that it's 30%. So it's all these are assumed values. Okay. So these are assumed values. This input data is assumed values. And I've taken the latest year's uh, income statement and balance sheet of the firm. And using the input data and the latest year's financial statement numbers or numericals, I'll be preparing the projected financial statement for the next future years. Here I've taken 5 years, you can do it for 10 years also, you can do it for 3 years also. Okay, so here I'm using my opinion method, and as I told you, these are my assumed data. Tax, sales growth rate, tax rate, and dividend payout ratio, what the company would pay out as dividends out of the earnings. And the average interest rate, that is the loan rate. Okay, here I've assumed that it to be 10%. What do we mean by EFN is extra fund needed or external fund needed or discretionary fund needed or discretionary fund needed. So usually short-term debt is something which they will go in for if they need extra funds. Okay. So these are my assumptions. So based on these assumptions and based on the latest year's annual financial statements, using the percentage of sales method, I'm trying to prepare a projected income statement and balance sheet. So this is my income statement and this is my projected balance sheet. Both of them I'm having it in the same, and I've used some formulas also. I'll be teaching you how we're going to use. And here one more thing I want to tell you all. And see, first what we do here is we are going to project the sales revenue or the revenue from operations. Okay. So every year it is 33%. So next year what? So every year the sales grows by 33%. So next year the sales would be, for the year 2023, the sales would be previous year sales into 1 plus the growth rate. Growth rate is your 33%. One second. So usually we'll start with sales which is 100%. So we'll point 33. So first we will start with projecting the revenue or the sales revenue from operations. So we know that sales will grow every year by 33%. So current year sales is 5 lakh. So next year will be 5 lakh plus 33% of this 5 lakh. So it will grow by. So what we do is for the year 2023, the sales would be previous year sales multiplied with 1 plus growth rate. So what is the growth rate here? It is 33%. So next year, with this assumption that sales will grow by 33%, your sales revenue from operations for the next year will be 6,65,000. From 5 lakh, it has increased to 6,65,000. Similarly, in further all the other years also, it is going to increase. So what I do is, anyway, I put in this formula, I am going to drag it. Okay, one second. This D4. E12, T4, no. Here, since when I'm using the formula, my 30, here I want you to be a little careful when you're applying the formula. See, what I did is I took previous year sales, which is 5 lakh, into multiplied with 1 plus growth rate. My growth rate is 33%, and this will be constant. This will be stable for throughout. But my this value, sales value, will change every year. So what I do is, for this growth rate, I'm going to use the F4 function. F4 function, so that my this value does not change. It remains constant. Because this value is constant, my growth rate is constant, I'm using function F4 and use it. So I'm going to drag this formula so that it is applicable for all. So this year 23, it is 6 lakh. Then for the year 24, it is when 33% increase, it increases to 8 lakh plus 11 lakh plus 15, and it is growing. So at the rate of 33%, my revenues are growing. And one more thing here, all my this cost of goods sold depends on my sales, correct? And cash operating expenses depends on my sales. So all these are dependent on my sales. So as a percentage of sales, I'm going to calculate this so that I can easily calculate these values for the future years also. But one thing you should be very careful, your interest payments, your tax payments, and your dividends does not depend on tax. It depends on other factors that I'll let you know. So first what we do, let's compute these percentages. So your cost of goods is as per the percentage. So what is the percentage of cost of goods sold to the revenue? So for that, let's calculate the percentage, that is cost of goods sold for the current year divided by the sales revenue for the current year. So 10% of the sales revenue from operations will be your cost of goods sold. So at this rate, we are going to compute the cost of goods sold for the rest of the years. So similarly, since our sales we are going to use throughout for all this, I am going to use function F4, so that all these percentages for all these values I'm going to create as a percentage of sales. That's why I'm using for D12, that is your sales or the revenue from operations, that will be stable for me as a numerator. So for that I've used F4 function so that it does not change. So now I'm going to drag this so that I'll get to know what is the percentage of cash operating expenses and other things. Okay, now I've got all these as a percentage. Gross profit or cash operating expenses, EBIT. See, and here interest payments, we know that it does not depend on the sales, but it depends on the amount borrowed. So that I am going to delete it. And your EBT depends on your interest payment. So that I'm going to delete. Tax rate also does not depend on sales, but it depends on various other factors. EAT also, and all the others. And even your dividends. So this I'll remove, this I'll remove, and this one also I'll remove. Okay. Here, remember we have this assumed data. So for interest payment, our assumed data was 10%. So we'll take that as 10% over here. And our tax rate is also assumed data here. It is the assumed tax rate is 30%. So that we are going to input here. So 30%. And our here, since we don't have preferential capital, we put it as 0. And dividend payout ratio, here it is 4%. So we'll be using 4%. So using this data, we will calculate the cost of goods sold, cash operating expenses, and other data for the rest of the 5 years. So for cost of goods sold, we know it's cost of goods sold percentage we calculated is cost of goods sold by sales. We got the percentage. And your tax rate is not based on sales, that also we learned. Even the interest and the dividend payout ratio does not depend on sales. So that your tax rate, interest payments, and dividend payout ratio depends on our assumed data. Okay, and we press F4 key wherever we want to have that value stable throughout. We don't want that value to change. Okay, so now let's compute. So your cost of goods sold for the next year would be your that is your sales into your percentage. 10% of your sales will be cost of goods sold. So that is a logic we are applying, and we want this to remain constant 10% throughout. So we'll use function F4 key. Okay, when you assuming that 10% is 10% is the cost of goods sold. 10% of your sales is the cost of goods sold. So for the year 2023, your cost of goods sold would be so much. Similarly, we are going to use the same formula for the rest of the years. We got the cost of goods sold. Then see your gross profit also changed. We have applied the formula. I think you all know how to compute gross profit. The revenues from operations less cost of goods sold. Similarly, cash operating expenses, it is 1% of your sales. So here we will do the same thing. Sales multiplied with 1%, and this 1% will remain constant. So a function F4. So your cash operating expenses is so much for, and we're going to drag the formula for the rest of the years to get the values. Then your EBT, and right now let's ignore interest. And as per the balance sheet, currently we don't have any debt. See here, we don't have any debt. Okay, and since it, and we'll also ignore the debt because it the debt will depend on the requirement in the future. So right now we'll keep interest payment as 0, thinking that, assuming that there are no debt for the company. And tax rate, we know how we compute tax rate. Is tax rate depends on your EBT, earnings before taxes. So your 30% is your tax rate. So your EBT multiplied with tax rate of 30%, and again 30% will remain constant throughout. So we'll use function F4 key. So this is the tax rate for this year, and similarly the same formula we are going to drag for the rest of the years to get the tax rate. And similarly the same logic we are going to use it for the rest for the others also. Here we don't have preferred capital, so there is no preference dividend or preferred dividend. So we'll input it as 0. Then dividends, we know it depends on the dividend policy. Okay, as per current policy, the dividend might be different percentage, but as per our assumed data, we feel that they pay 4% out of the net income as dividends to equity shareholders. So how do we compute dividend is, it depends on your net income. So 4% of your net income will become your dividends. So we're going to calculate that your net income multiplied with the dividend payout ratio, that is 4%, that is assumed data. Again, since dividend payout ratio, we are assuming it to be constant throughout. We press F4 key, function F4 key, and this is the dividend paid. Okay, and we are going to drag this value, this formula throughout for the rest of the 5 years. So we get it. So now we have retained earnings, additional retained earnings to the existing. These are additional retained earnings. See, basically what we have done is we have tried to project based on our assumption and based on the previous year's data. We have tried to prepare a projected income statement. And we have done this. And all this data depends on sales except your interest payments and tax and dividend payout ratio. Because your interest payments, tax and dividend payout ratio depends on many other factors, not on sales. So for that, we have used the assumed data and we have calculated. And here, out of the net income, they say we have assumed that dividend payout ratio is 4%. So out of this net income, 4% is paid as dividends. So remaining 96% of your net income will become the retained earnings. And this retained earnings will be an addition to the existing retained earnings. So that we are going to reflect it in the balance sheet. So here what we have done so far is we have prepared the 5-year projected income statement. Now I'll show you how to prepare the balance sheet. And even here, since we are using the method we are using for preparing the projected financial statement is percentage of sales method. So whichever directly depends on sales, we are going to use it as a percentage of sales and compute the future values. So here cash also depends on sales. So let's compute the percentage. So per your cash, the percentage would be current year's cash divided by your sales will give you what is the cash percentage against the sales for the current year, and this percentage will use it for the rest of the 5 years. And your sales will remain constant here, so we'll use function F4. So 1%, let me convert this. Okay. So 10%. So 10% of your cash will be 10% of your sales will amount to cash in your balance sheet. Similarly, the same formula we apply to bank, debtors, and closing stock, because your bank cash, your bank balance, and debtors and closing stock also depends on your sales. But whereas your net fixed assets will not depend on the sales, or even advance rent or miscellaneous. And even your paid up capital, retained earnings, all this does not depend on the sales. But your creditors will depend on sales. So your creditors will be, the percentage of the creditors will be creditors divided by sales or revenue from operations. Again, function F4. So 77% of your sales composes your creditors. So this is how we are going to. So now using this, let's compute. So 10% of your sales would be cash. So is equal to sales divided by 10%. Again, this 10% will remain constant. That is our assumption throughout. So function F4. So we got the sales value, sorry, cash value for the next year. Second. No, sorry. This should be multiplication sign. Your sales into multiplied with the percentage will give you the cash balance. Okay, so your sales multiplied with percentage of your sales against percentage of your cash against sales, that will give you the cash for the year 2023. So same formula we apply for the next 4 or 5 years. So these are the cash, projected cash. The same thing we are going to apply here also, is equal to your sales multiplied with function F4. So this is your bank balance. Hope you're all getting it. We are using the same logic like how we used here, and this also similar way. Your sales, because it is as a percentage of sales method, multiplied with the percentage of, it's 100% debtors. Okay, so function F4. similarly, your closing stock as well. 24% of the sales will be your closing stock into 24%. Again, we are assuming it to be 24% constant throughout. So function F4. So this is your closing stock for the next 5 years. So here now in the balance sheet we were able to project for cash, bank, debtors, and closing stock, which is as a percentage of your which is as a percentage of your sales, and we will look into these things now. Now let's look into the paid up capital. We assume that the paid up capital remains the same; it does not change. So your total capital also remains the same. Your retained earnings for the year is here additional. So currently you don't have any retained earnings. So whatever currently you don't have any existing retained earnings. So additional to retained earnings is so much. So is equal to this. Okay. So we'll use this plus this will be your this much will be your retained earnings. So again we're going to use this formula because your retained at so existing rate, when you're calculating the retained earnings for the next year, 2023, existing is so much, this plus the current years. So is equal to this plus the current year's retained earnings. Okay. Similarly, existing plus the current year's retained earnings. So total capital is so much. Then debtors as a percentage of sales, so we are going to use it, is equal to 77% of your sales will be your creditors. So this, how we can compute, how we are going to compute is your sales or the revenue from operations multiplied with the percentage of the creditors against sales, that is 77%, and this is constant, so function F4. So this much. So we have calculated creditors. Now we will look into the short-term loans, whether we need or whether they need to. I'll tell you why, how. So now let's learn about how to compute fixed assets, advance rent, and miscellaneous expenses. And here your advance rent and miscellaneous expenses does not depend on your sales. Okay, whether the sales are less or more, you will have to pay so much of rent. So what we do is we are going to maintain this as it is. Okay, we are going to maintain this as it is same stable since it does not change because of sales. Your net fixed assets to some extent is connected to sales, so we will try to calculate the percentage of net fixed assets to sales, because as you increase the sales, maybe you might require the fixed assets. So here it says that 120% of your sales is composed of fixed assets. So using that, we'll compute the fixed assets for this. So is equal to sales into percentage, that will give you the fixed assets it is probably planning to have. Sales into percentage of your fixed assets against sales, which will remain constant at 120% we need to have. That is what it says. Function F4. Okay, so this will be your fixed assets value. All these are based on your sales. The other things, these two we are remaining, it will be, see your advance rent, miscellaneous expenses, paid up capital, all these three will not depend on your sales. So we have maintained as it is. We have used the same values. Again, we are assuming and we will maintain same values throughout. So here we have computed. Now, your total liabilities, total capital, total of your total capital and total liabilities. And here next, let's learn this, that is external fund needed or extra fund needed and or discretionary fund needed. So how do we calculate this is, say we'll take total assets, from that we'll deduct total capital and total liabilities. And by doing this, we'll get to know whether the company needs extra funds or not. Okay. So is equal to your total assets minus your total capital minus your total liabilities. So it says that uh, they have excess funds, so not necessary to borrow. So they have so much excess funds. So we will use this formula throughout. Okay. And cumulative, how we compute cumulative is this plus this is equal to this plus this. So we have got, and here total discretionary fund needed is the sum of this. Okay, the total of your external fund needed or discretionary fund needed, the sum of this will be here. But if this total discretionary fund is more than zero, that means that there is surplus funds, the company need not borrow any new funds. But if it is if it is less than zero, if it is more than zero, that means that if total discretionary fund needed is more than zero, that means that the firm needs extra funds. So in this case, see, it will change. Here I have input one function called as if function. So if D 56, that is your total discretionary fund, is less than or equal to zero, that means that there is surplus funds. We need not borrow any extra funds. If it is more than zero, that means there are deficit funds. We need to borrow extra funds. So that is what we mean. So when we have projected for the 5 years, when we took the total of it, we felt that there is excess funds or surplus funds with the organization. So there is no need for the firm to borrow extra funds. And to determine maximum sales growth, sales growth rate that helps to achieve our forecasted goals without additional fund, we use goal seek tool under what if analysis. One second, I'll show you here. Formula. See, one thing you can see here, it was initially there was no values in short-term loans. This I marked it so that I want to show you this, highlight on this. I marked as zero because we don't know whether the company needs short-term loans or not. So depending on the values I have put. So minus means they don't need short-term loans. They have excess funds. So here how do we compute this is opening short-term loans plus current short-term loans. So you can see D45 previous, that is previous year's short-term loans plus current year's short-term loans. So this plus this. Same way, we use that form. I have used this formula. So how did I compute short-term loans? The formula which I used was opening short-term uh, loan plus current short-term loan, or previous year's short-term loan plus current year's short-term loans. So with this, with this we have prepared. With this we have prepared the projected financial statements and see here. If we feel that your sales growth is only 10%, if we change this, see the values also changes in the projected statements. And look at the funds needed. Still there is surplus funds needed if there is only 10% growth. But if you change it to 1%, if you change it to 1%, again there are a lot of changes. There is surplus funds. But if the growth rate is 50%, let's increase the sales growth rate, and all the values also changes. Again there is surplus funds. If the growth rate is 90%, so if the growth rate is 95%, see you get a positive value for total discretionary fund needed. That means you need so much funds. So it tells you that there is deficit funds and we need to borrow extra funds. So by preparing this, you can easily get to know by change, I mean, in the worst case scenario, when the sales growth is very low, how the financial statements would look like in future. In the best case scenario, when the sales growth is higher, how the financial statements look like and what is the funds you might need to achieve that highest target. So this is how it will help. So now we'll go back to the 33%. So this is how we have this is how we prepare a projected income statement and balance sheet using the percentage of sales method. Here, one more thing I want to highlight. So you have understood how we compute these values and also how we have got. And for miscellaneous expenses, what I'm trying to do is I'm trying to take the difference between the total assets and total liabilities. That is difference between the total liabilities and the rest of the assets. So that the balance can be got into it. So after doing this, you can see that your balance sheet also tallies the total assets, matches with your total liabilities. So this is how we have prepared the projected financial statement, which can be used for decision making and strategic financial planning. Hope this is useful to all of you. And here I want you all to prepare a projected financial statement for the chosen company of yours for the project purpose, whichever company you've chosen. Using this video, looking at it, try to prepare the projected financial statement for your firm for 5 years, and this will be one assignment for this week. And I'll be sending you the link in the Google Classroom so that you can upload the projected financial statement, which is prepared as a part of group activity for your group through that link. Okay, see you all. Have a good day.